For those who haven't met me before, Alastair Abbott, been at Australian Audit since 2008. Did my Masters in Forensic Accounting, also a Chartered Accountant, Registered Company Auditor, all sorts of other audits, and about time to get a new photo, but that's what I've got for now. This is all just education, so don't sue me if I tell you anything wrong. We have to put the disclaimers in, so but I've done my best to make it as accurate as I can, so hopefully you get something out of it. What I'm going to go through today is what is this change of the new leases accounting standard, comparing the status quo of what we've got now, going into the new definition of a lease, what it actually is, a few exceptions, the accounting entries for it, and a few examples and implementation through it as well. So hopefully it's reasonably interesting and practical for you. So to put it into context, you've got the current accounting standard, which essentially leases when you're renting something, renting an office space, renting a motor vehicle, whatever it might be. As you make the payments, he charges us an expense. It's nice and simple, and people understand it, but not anymore. To make our accounts more transparent and more accurate, we're going to change it all around. You had this issue where organisations were using leases as a way of providing off-balance sheet funding, and you had, for instance, the example of Borders Bookstore, where when it collapsed in 2011, the actual lease commitments they had were 7 times more than the liabilities that they had listed on their balance sheet. There was someone who famously said that they hoped one day to be able to fly on a Qantas plane that was actually on the balance sheet of Qantas. So that's some of the background to why this change has been made. The result being hopefully to give more accurate financial reporting out of it. The timeline of what does this look like? So back in 2016, the new standard was issued. So for all those people who are saying this is too big of a change, I haven't had time to get my head around it, it doesn't quite fly anymore because we're now 3 years after the standard was actually issued. 1 January 2019 is the date to look at for actually implementing it. So it's your financial year that begins on or after 1 January 19 where you have to apply the new standards. So that will mean for most people with a 30 June year end, it'll be your 19-20 financial year where you'll be required to apply the new standard AASB16 on leases. For those with a December year end, 6 months earlier, so from 1 January 2019. There is the option in the standard for retrospective application, so you actually have the option when you apply it to go back to your 2018 year and redo the accounts as though you've applied the standard, so you have comparatives that match up, or you have the option to use a practical expedient where you leave last year as it was and you just make the changes from 1 July 19 or 1 January 19 and move forward. It's a much easier way to implement it, but it does mean you'll have a set of accounts where the 2 columns won't be particularly comparative, and you just have to put a little bit of extra disclosure to explain it. So who does this actually apply for? Most people sort of think accounting standards, I don't really need to worry about them. We're a small organisation, our accounts, we'll just do what we want. Unfortunately not. So anyone who's preparing special purpose reports, that idea of these are special purpose, we're not applying all the accounting standards, it's a little bit of a tough luck. If you're doing special purpose, in most cases you have to apply the recognition and measurement principles, which means even if you're not doing all of your disclosure following all the accounting standards, you still have to use them to calculate the numbers at least. So that means if you're applying financial statements where they say these are true and fair, if you've got anything that says you must apply AASB 101, if you're doing general purpose reporting, if you have anything that says you must apply all Australian accounting standards, this applies to you. If you're an incorporated association or registered with ACNC and you're over the 250,000 turnover threshold, you have to apply this. If it's an Aboriginal corporation, it applies to all of them. If you're a large proprietary limited, if you're an AFSL licensee, if you're a small proprietary limited lodging with ASIC because you've got foreign ownership, any of those entities, you will have to apply this new standard. So it's at that stage of you have to get your head around to understand it, and whether it's from board members looking at financial reports and being able to understand what they're seeing, or from the accountants doing the accounting, it is going to be quite a significant change. So, by way of introduction, nothing's easy, right? What is the actual change that we're talking about? If it's lessor accounting, essentially nothing changes. It's the same as before. So, easy. For everyone who's a lessee, if you are renting anything, renting a property, renting a motor vehicle, renting office space, whatever it might be, renting servers, the new standard is applicable. And to summarise it as succinctly as I can, anything that you used to have as an operating lease will now be treated as a finance lease. That's the most condensed summary of the new standard I can give you. What it means is that on your balance sheet, you'll have higher assets and higher liabilities than you used to. On the income statement, you won't have rent expense, instead you'll have interest expense and depreciation expense. And on your cash flow statement, where you used to have operating cash flows, you'll now see financing cash flows. So it's a change in presentation. Things to be aware of is if you have KPIs for anyone that are based on financial metrics, the change in accounting standard could change people actually achieving their KPIs. So if you, for instance, have a CEO of the organisation and their remuneration is based on the operating profit of the organisation, simply by changing the accounting standard, your profit could increase because you have less rent expense, and instead you've got interest expense and depreciation. So if you're using your earnings before interest tax depreciation figure to base the KPIs on for the remuneration of the CEO, you might want to be reviewing the contracts to make sure that the change in accounting standard isn't going to result in a bonus being paid when nothing actually was changed.
And this is just for the end of the year reporting, or it will be just for every month, or means
that's where it becomes optional. So yes, at the end of the year you must apply the new standard.
Okay.
What we're seeing though is if you do your accounting month to month following the old standard and then make an adjustment year end, it'll create confusion for the board members because they'll be used to seeing their reports in one way, and suddenly at the end of the year everything's different. So as much as possible, we'll be encouraging people to make the change throughout the year so you have consistency and to help people understand how the accounting for it works. I know for sure there will be many organisations that still can't quite get their head around it and leave it as year-end adjustments. And that's...
So I just wanted to confirm one thing, that there are fixed costs, right? And where there are KPIs, so we cannot pay fixed costs if we have not met KPIs for that particular month.
I don't quite follow the question, sorry.
So such as we pay rent, we pay that was salaries and wages, which is fixed, right? It is fixed. How much rent we pay, how much that was salary we pay to the employees, and where there are KPIs, that was performance, and so if we have not met our performance KPIs for that quarter, means how will it affect?
So it's in the situation if people's remuneration is actually based on the KPIs, which is less common, but you do get situations, especially say with a CEO, where their package might be, if you meet a certain target of profit or a certain metric, you'll get an extra bonus. It's that extra bonus where you might say the CEO actually did a bad job, but because of the change in accounting standard, they see a higher profit and you end up paying them a bonus. And that wouldn't be an outcome you would necessarily want. So it's being aware of that, so you make sure that the contract actually removes the impact of the accounting standard or the change in the accounting standard, so that's not resulting in a bonus.
Can you, excuse me?
Yeah.
If the contract's already been set, because the standards are changed, does that give you a loophole to change the contract?
That's a legal question for the lawyers, but I think it's something where at least you want to make sure you're aware of it, because for boards, if you're not aware of it, you'll end up paying the bonus without even thinking about it. At least if you're aware there's a change, you can go back to the CEO and say, well, can we change your contract, or do we need to get the lawyers to involved?
And if they don't address it, then they're in breach of the act. No?
Not necessarily. It just means that you could end up paying out a bonus when that person hasn't actually done something to specifically warrant it.
So if a bonus is paid on, say, increased income, that's not a problem. If the bonus is also paid on the additional surplus, and so long as the surplus is calculated after all of this,
If the surplus is calculated after interest and after depreciation, the change will be very minimal. I've got an example in a few slides where you'll see the amount of it, so it does change a little bit, but not quite as much. So, starting with the status quo, what are people actually currently doing? Operating leases are not on the balance sheet. You record rent expense as you make each payment. Operating expenses, operating cash flows. Nice and simple. It's what people understand. So we'll work through an example with a few numbers to hopefully be able to clarify for you what people currently do and how it changes. So we're looking at the example of a rental of an office space. We're saying it's $72,000 a year for a 3-year contract, and the incremental borrowing rate of the lessee, we're putting at 10%. Now, incremental borrowing rate, that is, if you went to borrow money from the bank to buy this asset rather than renting it, how much would the bank charge you in interest? Now that becomes quite important in being able to calculate what that percentage is, because for every lease, you will end up needing to be able to identify your incremental borrowing rate, which becomes a bit unusual for a lot of charities and not-for-profits where they might not be used to borrowing. So if you have recently borrowed or applied for loan finance from a bank, it's a bit easier. If you haven't, there's then statistical tables from the RBA that you can access that actually gives a list of different risk type loans and what the current interest rates are. So there are alternatives available, but you're trying to say what's specific for this particular organisation rather than just what's the RBA cash rate. And here we go, the profit and loss. What actually happens? So, current year, under the current standard, operating lease expense 72,000, total expense 72,000. Nice and easy. Second year, same thing. Third year, same thing. Under the new standard, you no longer have operating expense in any year. You have interest expense and amortisation expense. Amortisation, the same as depreciation, but for an intangible asset. So, to try and make sense of it, amortisation, because it's straight line, you've got the same amount in each year. But the interest expense, because if you think of a loan, when the balance is higher, the interest is more. When the balance is lower, the interest is less. You get a change. So you're actually showing a higher total expense in the first year and a lower total expense in the final year. So just by the change of accounting standard, you actually end up with year to year the amount of expense changing. At front ends the expenses, whereas people are used to more of a straight line approach. So you can see it's not quite as simple as saying the total expense stays the same. The total expense across the 3 years is the same, but in each year you get higher expenses at the start and lower at the end. The balance sheet, because it was an operating lease of your office rental, you're used to seeing nothing on the balance sheet. In the first year, you have a right of use asset. Now, the right of use asset, it's similar to a PP&E type asset, so it'll sit in the same section of your balance sheet as your land and buildings, the property, plant and equipment section. And you also end up with a lease liability that gets split between current and non-current, because you've got the portion that gets paid within 12 months, the portion that's beyond 12 months. thing to take from that is that if you've got anything that's based on ratios, if your current ratio, for instance, might be one of the bank covenants in bank debt that you've got, simply by changing the accounting standard, you have more current liabilities without more current assets. So your current ratio worsens, and if that's one of your bank covenants, you could then have the bank coming to you saying, well, repay the loan because you've breached the covenants, or your interest rate's going to increase because of the different covenants. So for any organisations with significant debt, it's important to be talking to the bank in advance so that you can actually start that conversation of, well, how is the change in accounting standard going to impact our relationship in terms of our bank finance? And then you've got the cash flow statement, which some of the smaller organisations still don't prepare, but for those that do, you'd be used to seeing as part of your operating expenses, your cash outflow $72,000 each year. You'll see that for cash purposes, it's still $72,000 in each year, but it changes so that you now have it showing partly in the finance or the operating section, depending which your presentation is. So interest expense, you actually have that choice. For the repayment of principal, that one sits down in the finance section. So your operating cash flows will actually improve simply by applying the new standard. You can see why there's some complexity here to get your head around. The next question then is, well, what is a lease? To what transactions does this standard actually apply? If only things were simple, right? The definition of a lease changes. So under the old standard, it was a lease is an agreement whereby the lessor conveys to the lessee in return for payment or a series of payments the right to use an asset for an agreed period of time. Under the new definition, which is the new definition of a lease, it's now a contract that conveys the right to control the use of an identified asset in exchange for consideration. So consideration rather than payment, it doesn't have to be a cash payment, it can still be a lease. The identified asset becomes important because if you are paying for the use of something but it's not an identified asset, so say for instance you were renting some piece of machinery or equipment, so like a lifter or a crane type of digger type equipment, and Kennard's Hire can come to you and just switch it out for a different machine any day they like. You're just renting that machine, but it doesn't matter which serial number, which machine it is. It's not going to be a lease because there's no identified asset. Whereas if you were BHP and you were renting one of their large trucks up on a mine site, it would become an identified asset because the lender or the owner of it can't just come and switch out an asset because of the remoteness. It becomes identified just by the fact that they can't easily change it for a different one when they want to.
Is that the same as, say, having a building that's got a water fountain, drinking fountain as a fixture to the floor? You can't just move it. If you moved it, you'd have to do water and electricity. Therefore, that asset, it's got to be that is.
Yeah, so it's the same sort of considerations where the practicality of changing something actually comes into the definition. But even if, from a legal sense, maybe they can change the asset, from a practical sense, if they're not easily or economically able to, it defaults to them being an identified asset because the owner of the asset can't easily change it.
So the fixture, because it's a permanent fixture, therefore is considered the asset. Therefore, the asset, when you look at the lease agreement, is not a maintenance thing, it's a structure.
It can be, yes. And the control the use of then becomes the other part of the definition. So if you as the person receiving the benefit don't actually have control over the asset, so this can happen in sort of, I guess, transport type situations where if you consider the difference between renting a truck where you drive your goods from Sydney across to Perth versus handing the goods over to someone else to transport it for you, where you're renting the truck and you're driving it, you choose which route, you have control over it. If you're just providing a sea container and saying, get this sea container from Sydney to Perth, you no longer have control over which route it's taking, which day they might travel. It then means you don't have control, so it becomes a service contract rather than a lease. Which might be good, because then you don't have to worry about all the accounting for it. So what sort of things are we talking about in this definition? Could be anything you're renting: land, property, vehicles, machinery, servers, photocopiers, and you can even have situations where you have one contract that has a lease and a non-lease component. So it could be that you're renting a motor vehicle, but the owner of the motor vehicle is still responsible for the maintenance of it. So you have one contract that could provide you with a lease of a motor vehicle, as well as a service contract for the owner to provide the ongoing maintenance. Or it could be similar with a photocopier, where you often with a photocopier are paying a charge per page as well as a charge per month, and the combination of that is then paying for the use of the asset as well as the ongoing service and maintenance of it. So, some people like diagrams. To try and put it in a diagram, how does it work? To say, is it a lease? You first have to have an identified asset. So if it's not an identified asset, it's not going to be a lease. The lessee has to receive the economic benefits from the use of it, and that's all of the economic benefits, not just a small component. If you don't, it's not a lease. And the lessee has to be able to direct the use of the asset. So if the lessee is not actually able to control the when, the why, the detail of how they're using it, again, it's not a lease. And you just account for it as a service contract as you currently are doing. But if you meet all three of those, there is then a lease in the contract, and you then have to apply the new standard in accounting for it. So, a couple of examples to try and tease out the differences for you. So, we've got the situation where the charity is organised with an airport operator to rent some space where they can put up their kiosk and do some fundraising and marketing activities within the airport. Now, it's for a 3-year period, and the contract defines the number of square metres of space that the charity has to have access to. But the airport is able to choose which boarding gate they'll put that person at. So from day to day, when the charity turns up, they might be told, well, you're at gate 40 today, gate 45 tomorrow, gate 10 the next day. And the kiosks that they have, they're basically able to just wheel around the airport. So there's no problem or difficulty in them moving them around, and it will create benefits for the airport by having that flexibility to put the person where best suits the airport. So the question then comes, is this actually a lease? Is there a lease contract in here at all? Correct. So it's not a lease because there's no identified asset. There's that amount of space, but it's not like where you're renting an office where you know you will always be at unit number 10. This is, you know you'll be at the airport, but you could be anywhere within the airport. So it's a contract for access to space, but it's not a lease.
If it is specified that this space will be from gate 1 to gate 40.
So if the lease specifically said which space you were going to be at, so if you knew you always, for the whole 3 years, were going to be in that little spot right outside gate number 40, and you were always going to be in that same spot, then it could be a lease. We've then got the example of renting a truck. So if you rented a truck that you were going to transport some goods from Sydney across to Perth, you as the lessee provide the driver, you choose the day, the time, the route, then the question then is, well, is it going to be a lease? In this case, yes, because you have the use of it. The note here is that it's only for a period of 1 week, so it actually comes under the exceptions that we'll come to a little bit later on. And the other thing is that even if the lessor put restrictions around your use, so maybe in your contract, the lessor says you're not allowed to transport flammable goods, you're not allowed to transport uranium. That doesn't stop it from being a lease, because remember in the definition of a lease, the lessee has to have control over the use of the asset. The fact that the lessor puts in place a restriction, it's a protective right rather than an actual direction, so it doesn't stop there from being a lease in that situation. IT network services, so if you've engaged with your IT contractor to provide servers and networking for you, and you've got a contract that for the 2-year period, they have to make network services available, there's specific speeds they have to achieve and so on. But the supplier has complete control of what servers they put in, they can change them out as and when they want. You end up not having a lease of that server equipment because the supplier is in control. You're just engaging with them to provide a specific level of service, but there's no identified asset, and in this case it doesn't even matter if it was identified or not, because the lessee has no control over which asset is being used, or the lessor has the complete discretion there. If instead you engage with the supplier and said, I want access to a server for 3 years, the lessee is controlling which server it is, where it's installed and so on, then you do end up with a lease. So you can see the sort of minor differences in the contract result to it being a lease or not, but that can then have a significant impact on your financials, because if it is a lease, you'll end up with the asset and liability on the balance sheet, all those changes we went through just before. And if it's not a lease, it's just going to still be an operating expense as you'd currently be doing.
But it is only if we have paid the money for 3 years in advance, or?
No, it doesn't matter, because the actual timing of the payment doesn't necessarily have to be linked to when you record the expense. So you could have all the cash payment at the start, all the cash payments at the end. It's not going to change the expense you're recording on the P&L, it's just going to change the amounts on the balance sheet as to how much is payable or paid in advance.
Can you change him, Mike? I know you said before that, you know, it makes it harder when you get to the end and then you realise you've got to redo it, blah, blah, but, you know, if you think that something really is a contract, and then when you weigh it up and have another think that you think it's a lease, you've got to then get the lawyers in to change it from a contract to a lease, which could be costly anyway.
The idea would be that when you make an assessment of the contract, your assessment shouldn't change over time unless the contract itself changes. So, yes, if you make an error in assessing it, and maybe it wasn't a lease and you thought it was, there's an accounting standard, AASB16 that gives guidance on how to account for changes because you made an error. But if it's not that case, you wouldn't expect there to be a change, because while the contract is the same, the terms of the contract don't change. It's not going to change from being a lease to not being a lease just through the passage of time.
But an organisation would make more money than a lease than a contract.
Make more money, I guess. The actual cash in the bank isn't changing, it's just the reporting of it. So yes, maybe you might end up showing a different level of operating profit in 1 year if it's a lease or not a lease. It'll show you slightly, so a few exceptions to lease accounting, which if you can fit into one of the exceptions, it might help you avoid the hassle of it. People are going to say, well, I'll have an 11-month lease with 10 options and I'll just roll it over every 11 months and it won't be a lease. And the standard setters said, well, tough luck, no. If there are options that it's reasonably certain you'll exercise, now this is a new term that they have brought in of what is reasonably certain. It's not a term we've had to deal with in accounting standards before, but it's now there. If it's reasonably certain that you'll exercise the option, then you include the option period as well as the original period in determining the length of the lease, and then account for it accordingly.
So our organisation has operating leases on vehicles.
Mm-hmm.
Vehicles are generally turned over every 3 months. So we have an operating lease for a vehicle for 3 months, that's then sent back and has a new operating lease. Now, to me, that comes under that exemption, but because of the fact that we're reasonably certain to take out another operating lease on another vehicle similar to that vehicle, how would that sound?
That's going to be an interesting one because it's a different asset. It's likely that each will stand on its own because it's not an option to renew the lease, it's rather a new lease on a new vehicle.
Okay.
So,
That's good news.
different assets. So, the other exemption you've got is low value assets. Now, again, the accounting standards that we've got, they don't give us bright lines, but what they have said in the standard is that a computer is a low value asset, a motor vehicle is not a low value asset. So in the guidance statement, they've said, use the example of US $5,000 as a rough guide of where they think that cutoff is going to be, but that's in the guidance material, not in the actual standard itself. The election can be made on a lease by lease basis, so each individual lease you can look at to say is it low value or not. But looking at it, because we'd say the cheapest car you can find is going to be about the $10,000 mark. We're looking when it's new. Computers are going to be maybe the $3,000 to $5,000 mark, so about the $5,000 mark is where you'd be expecting. If it's below that, you've got a good chance of it being a low value lease. If it's above $10,000, you're not expecting it to be a low value lease. You get the situation of multiple low value leases. So for instance, someone like a school might have a lease for a couple of hundred computers. They might be providing small computers for all of the students to use. Each one individually might be $500, but if you're leasing 1,000 of those computers, you suddenly have a large amount. And so in that case, you have the option to choose whether you want to treat each individual computer as a low value item, or if you want to account for the portfolio of leased computers as a package and treat them according to the standard, put them on your balance sheet.
If it was as a package, like you have a package deal, that there's 100 computers that you're leasing, that lease, because it's one contract, would still be caught then. It wouldn't be a low value.
One contract could have multiple leases within
It
the
could still
contract.
be. Okay.
So the fact that it's done as one contract, or you could have situations where you have multiple contracts, but they're so interdependent that you actually bring them together to account for them. So they've put these details into the standard because they've identified that people are going to try and find ways to either have multiple contracts or one contract to get around how they want to account for it. And they've said, well, it doesn't matter, we're looking at the actual detail of what's happening, not necessarily how many documents there are. So what does it look like when you go to actually do the accounting data entry for this? So on initial recognition, so that's when you first start applying it, you bring onto your balance sheet a right to use asset and a lease liability. At the start of the process, they're going to be pretty much the same amount, so your total lease liability, your total asset, the same dollar amounts. Current, non-current, as we saw before, it won't be quite the same, but it's not going to change your net assets particularly. The lease liability that you start with is based on the present value of lease payments due. So present value calculation to do in there. Again, everyone throws up their hands and says, I don't want to do this, it's too complicated. There are a few software packages around that can actually do these calculations, but most of them are rather at the expensive end. So I think a lot of people are going to end up using an Excel spreadsheet to do these calculations. The leased asset is measured at cost, but again, cost is a variable amount. So you start with the lease liability, but then you adjust it for lease payments you may have made in advance. You reduce it for lease incentives. You then adjust for the lessee's initial direct costs. So if you had to engage some lawyers perhaps to draw up the lease documentation, that comes into it. And you account for your estimated dismantling costs at the end of the process as well. So even with that, you can have a starting point where the cost and the liability are not quite the same as each other. You also at commencement on first application have the choice of a prior period restatement or not. So the prior period restatement is where you want to have comparatives that match up and are nice and neat, and so you end up going back redoing the prior year figures and you get comparatives, but there's a lot of work in doing that. The alternative is you say, we're not going to worry about it. The amount of the change on the application of the new standard, you just put straight into equity on that first entry, and you start applying it from 1 July 19 going forward. And most organisations I've been talking to, that's the approach they're looking to take, because why waste time if you don't have to? They've given us the practical expedients in the standards, so make use of them. The other things to note is that when you're calculating it, you do include any fixed payments as well as optional payments that are reasonably certain. So they've put in things, so for instance, if you have a lease of office space and it says you have to pay it as long as there isn't a flood or an earthquake. Now, it sounds like that's variable, right? Because there might be a flood, there could be an earthquake, and you might not have to pay. But because the likelihood of not paying is so minute, you essentially treat it as though it's a fixed payment for the purpose of the calculation. The same could be the case where you might have a rental of a shop where you're going to be selling some goods, and if the contract says as long as you sell $1 of sales in the month, you have to pay a certain amount. It's not going to be treated as variable because the expectation is you would sell much more than that. Residual value guarantee, so if there's a fixed amount at the end, that gets taken into account. But what doesn't get taken into account is variable lease payments. Now that's often the case if you're renting retail space where it'll be a percentage of your sales that is treated as your rent. Because you don't know what your sales are going to be, you can't at the start account for that as a liability because there's no way of quantifying the number. So the portion of your rent that is based on the percentage of your sales gets accounted for like you currently do, and the portion of your rent that is the fixed amount gets accounted for under the new approach with the on-balance sheet as liabilities. Optional payments that are not reasonably certain, so if it is optional or variable and it is genuinely optional or variable, then again that comes under that. And if there's service payments, so the situation where you're renting a motor vehicle and then there's the component of maintenance that's built into it. That maintenance component gets excluded, or the maintenance of the photocopier that's built in gets excluded.
How about renting an office space and there's also variable costs, such like electricity and cleaning the common areas or stuff like that?
So the variable components of electricity, of cleaning, those are genuinely variable, and those get treated as you currently do an expense when you pay them. Likewise with CPI increases, because you don't know what the CPI in the future is going to be, you do your calculation based on the current rate, and then as the CPI changes each year, you then make modifications as you go.
So to do the modification, does that go then to your equity account as well?
No. The adjustment to equity is a one-off change on initial application. After that, on lease modification, the standard has some quite detailed guidance on if this changes or that changes, how to account for it. I haven't in the presentation gone into it, but there is guidance and as to how you account for those modifications. So what is the present value of your outstanding lease payments? There's two ways to calculate it, and in almost all cases, you're going to end up on one side rather than the other. So it says in the first case, if you know what the lessor's initial direct costs are, that's the better method. So this is the case where perhaps you might be renting a motor vehicle and you know what the market value of that motor vehicle is. So you know what costs the lessor is incurring, and perhaps if they're related parties as well and you've got access to that information, you're then able to account for the lease based on the actual cost of the asset and work out the interest component that the lessor is actually charging you. But in almost all cases, you're not going to know what the lessor's costs are. So that's why you will almost always end up at the present value of future lease payments, and that's where you're bringing in the lessee's incremental borrowing cost. So incremental borrowing cost becomes an important percentage rate to be able to identify. It could be different for different assets. So for instance, because if you borrow money to buy a property, you'll be charged a different interest rate to borrowing money to buy a motor vehicle. Then when you lease a property versus lease a motor vehicle, the incremental borrowing rate is going to be different. A small change in that rate on a larger lease could have quite a significant impact on the balances coming to your balance sheet. So I can straight away see there's going to be arguments between auditors and clients as to, well, what is the actual rate? What evidence can be provided to demonstrate that the rate being used is appropriate? I've already had one client who has done the schedule of the calculations of this for the multiple properties they're using, and they put in an incremental borrowing rate of about 2.5%. Now I've gone back to them and said, well, how can you justify 2.5%? Because I'm not yet convinced that you could go out and borrow money to and these are residential type houses. I said, I'm not sure you could borrow money from the bank and pay 2.5% interest to purchase a house. And they haven't yet been able to give me any evidence to prove that they can access that. So in their spreadsheet, when you change the percentage from 2% up to more like 6%, which is probably more reasonable for them, the actual amount on their balance sheet is changing by hundreds of thousands of dollars. So you can see that it doesn't take a large change in the percentage to have quite a large impact on the accounts. Subsequent measurement, so the cost model is what most people are going to end up doing because it's a little bit easier. So you essentially just have the depreciation on the right to use assets, straight line across the period. It goes down nicely, and you adjust for any impairments should they arise. But you do also have the option of the revaluation model. And the point to note here is that if you are revaluing the properties that you own, you will also have to revalue the properties that are accounted for as leases. So if you've looked at that revaluation on your balance sheet, you've got the ability to have some assets cost and some revalued, but you have to do the same treatment for the same class of assets. So if your properties that you own are revalued, then the properties you've got leased, you will also have to revalue the right of use assets for those leased items. Other adjustments that can occur, so there's remeasurements when the lease term changes, when a purchase option changes. So Amanda, this is what you were saying before. Well, what if we weren't expecting to take out the option and now we are? So you could have a situation where you are renting a small piece of office space, you accounted on the basis you wouldn't exercise the option to renew, but then a couple of years later, you go and rent the office space next door to give you a larger space because you've had significant growth. And now you judge, well, yes, you are likely, it is reasonably certain that you will take up the option. You then have to redo the calculations based on saying the lease term has changed. There might be leases where there's a purchase option built in at the end, and if you're originally not reasonably certain to take up that option, and down the track you change your mind and say, well, now we are reasonably certain, again, you're updating the calculations to reflect that. Implementation. So, actually putting this into account. The practical expedients that I spoke about. Now this is the good news in the standard. There's not much good news there. So you have the two options, as I've said, full retrospective or modified retrospective. So the full retrospective is you follow AASB 108, you go and restate it, your balance sheet has 3 columns. A lot of work that no one wants to do. Modified retrospective, cumulative amount comes straight into equity. That's the easy option. In addition to that, if you take the easy option and do the adjustment with everything going into equity, you get bonus, because you can also apply these additional practical expedients that you can't apply if you're doing full retrospective. Leases that have less than 12 months to go at the date of application. So you might have situations where you had a lease in place, it might have been a 5-year lease, and it will end 11 months after you start applying the standard. You get to ignore it and just calculate those last 11 months applying the old standard. Makes it easier for you. It's good news. There's not much good news in here. So, simplified use of right of measurement. So, where you've got leases in place, you don't have to go back to the inception date of the lease, account for it at the inception date, and then roll it forward. You can just say, well, as of today, on the date we're implementing the standard, what are the lease payments that are due as of today? That becomes your lease liability on the balance sheet. You put the same amount as your right to use asset. So it makes it a bit easier to, on your initial application of it. You can apply discount rates on a portfolio basis. So if you've got a group of assets, so maybe you might have, for instance, a disability provider who might provide or have ownership of 15 different houses that they provide care to residents. They don't have to try and calculate a separate rate for each house. They can say, well, it's a portfolio of houses, they all have similar risks, we'll apply the same rate across all of them. If you've got any onerous leases, you don't have to do impairment testing on them. You don't have to worry about initial direct costs. So for leases that you've already got in place, you don't have to go back and say, well, what were our initial costs when we signed up for this lease 10 years ago? Finance leases, you don't actually have to adjust. So everything we've been talking about is saying operating leases now you start treating like finance leases. If you've already got finance leases in place, they're already on your balance sheet. So when you adopt the new standard for the ones you've already accounted for, you don't have to go back and remeasure those. And you're allowed to use hindsight. So part of the standard is saying how reasonably certain are we that we're going to exercise an option. If you've already exercised the option in the past, before you start applying the new standard, you don't have to put yourself in your own shoes from 3 years ago and say, did we think we were going to apply it or not? You can go back and say, we actually already signed up for the option. We know we've adopted the option, we know we've taken it up. Yes, it's definitely reasonably certain because it's already occurred. So those practical expedients do make it a whole lot easier in implementing the new standard. So, where does that take us to? A few other things to address. Sale and leaseback no longer gives you the option of off-balance sheet financing. So a lot of people might have had an asset on the balance sheet, they wanted to get access to some debt funding, they would sell the asset, receive the cash, but then they would start leasing the asset and ended up, because it was a leased asset, there was nothing on their balance sheet. In a sense, they've got a liability, but they're not showing it. Applying the new standard, you miss out. You can't do that as a way of accessing finance without showing a liability on your balance sheet any longer. Sublease arrangements, they're just so horribly messy under this standard. Almost to the point that I'd say try and avoid having sublease arrangements, because when you're the lessee, at least you've got reasonably clear guidance of what you have to account for. Yes, it's a little bit more painful than what you were doing before, but it's nice and clear. You've got the right to use assets, you've got the lease liability. If you're the lessor, you have your finance lease recoverable as an asset, it's reasonably nice and easy. When you've got a sublease, you end up having to account as a lessor and as a lessee, and it gets messy.
So as you know, we have an incubator or and space from ECU, which we rent from ECU, and then rent it out to other clients. So is this same thing?
Yes. Unfortunately, yes. So in your sense,
So this is
you've
a
got
problem
one
for us, or for whom?
Yeah.
It is a problem for ECU or for us, or?
problem for you.
Okay.
do I say unfortunately?
So what do we have
in your
to do?
situation, you're renting an asset and then you are sub-renting it out to multiple. So you will have multiple situations of being the lessor, but a single situation of being the lessee.
So what is the solution?
Follow the standard. So in the sense, it does give clear guidance on what to do, but it just means that your accounts end up a little bit messy.
Okay. We'll discuss it in the
There's probably just more transactions and
Yeah,
more work.
more transactions, more work. But peppercorn leases, there's a temporary postponement. That's the good news out of it. So, for those of you who were here 2 weeks back when Bob gave his presentation on income for not-for-profits, you would have seen in that there's the new standard AASB16 which is called income for not-for-profits. That standard built in a requirement for accounting for leases that are significantly below market value. And what the standard said is that if you as a not-for-profit are leasing something below market value, and you've got that below market value to benefit the objectives of the not-for-profit. So it can't be just because you drove a hard bargain, it can't be just because you got a good deal or it was a fire sale, but it has to be someone giving you a below market rate to benefit you. So it tends to be sporting clubs who might have access to club rooms and fields at below rates, or some not-for-profit providers, childcare centres, for example, where they might get space from the council and they're paying $1 a year, the traditional peppercorn leases. Those were what was captured by this new standard. What it then said is you had to calculate the difference between what you're paying and what the market value of the property is. And that difference will come to income. And on top of that, you calculate the life of the lease. So if you've got a peppercorn lease with a 99-year period, you're calculating the present value of the next 99 years of the difference between the market value and what you're paying. And you bring all of that into income in the first year, and then for the next 99 years you depreciate that amount. And everyone looked at that and said, this is terrible. How are we going to account for this? How do we even know what the market value of our property is?
It has, okay, so this is the income side, and then what would the expense side, so that we can balance it out?
The credit comes in as income, the debit goes to your balance sheet as a right to use asset that you then depreciate over the life of the asset. Now that standard, which was due to be applicable from 1 January 2019, in their great wisdom on the 24th of December 2018, the Accounting Standards Board came out and said, we're going to issue a temporary deferral. You've still got the option to account for it under that new standard if you want.
So this is not for senior management, right? It is only for when we have to provide these reports to the board or any government organization.
Correct. So all of these standards are applicable when you're doing your year-end audited financial statements that you have to apply them for your statutory accounts. If it's your internal management accounts, as has always been the case, you can do whatever you want.
Did anybody, let the scouts know about this? I mean, the scouts have got scout calls and stuff all over the place. They've got peppercorn leases. I mean,
Yeah.
that's a huge cost to both the council or the state government, because they've got peppercorn leases all over the joint. I mean, who's going to wear all these costs?
That's one of the reasons for the temporary postponement, I think.
They also have proper one as well.
While the standard was issued in 2016, I don't think enough people had identified the impact it was going to have, and so it was only when it was starting to get a lot closer to the application date that a lot of organisations in the not-for-profit space started making a little bit more noise that it was going to be quite difficult to apply, and that even calculating the market value wasn't easy, because if you're looking at a normal residential property, it's easy to go on realestate.com and see what the rental price is. But if it's a scout hall, and the terms of the lease say that you can only use it for scouting activities, that restrictive covenant could potentially be so restrictive as to mean that the market value is negligible. But there wasn't enough guidance yet for it that people were going to be able to apply that consistently. So you could end up with different organisations accounting differently.
But then you have scout halls that you have a peppercorn lease to a hall, and under the lease arrangements they can rent it out to whoever they like. So you either become the lease police and go out and say, well, you know, you've got Pilates there this day, you've got childcare the other day, therefore then you've got the sublease issue going on, which I think no one will do. I think we'll just go black market
So
I should
pretend I didn't hear it, right? The other reason though was that with the ACNC review recently, they've suggested of changing the thresholds. So at the moment for ACNC registered organisations, 250,000 turnover and up, you have to apply the standards. But the review has suggested changing that to being $1 million as the threshold. And so the the AASB didn't want to bring in a new standard that created a lot of work for an organisation with a $500,000 threshold, only to in a year or two's time have the thresholds changed, and that organisation, having spent all of that effort trying to account for it correctly, no longer has to anymore.
But why pick on the peppercorn leases anyway? Because from the actual organisation point of view, they are actually not an asset, because nobody else is going to use them other than the scout hall. They're usually on Crown land or deemed land, you know, so they're never going to be of value to the organisation. This is just a management sort of a staff exercise that's going to cost a lot more money that really is not going to gain for anybody.
Yep. Well, that's what quite a lot of people have been saying about it. The reason for it is that because you've got the new AASB15, which is contracts with customers, and AASB16 Leases, so you've got a new way of accounting for revenue, new way of accounting for leases. They then brought out AASB1058, which overall is a very good standard for income from not-for-profits. When you bring all of those three together and look at, well, how does it apply in the situation of a peppercorn lease? Applying those standards, not that they're specifically written for it, but when you apply the theory behind them, the outcome for a peppercorn lease is to say, well, you have to market value, the difference is going to be as income. It's sort of the natural progression from the way those new standards were written. But as you've said, it creates a lot of additional work for people with no tangible benefit to them. And so because of that...
That's when there should be a common sense exception rule.
Yes, a little standard on common sense.
And the reason we don't have the common sense exception is because people would overuse it and do whatever they wanted when the standards didn't suit them. So, the good news out of all of that though is that peppercorn lease accounting, you don't have to apply for now. At the moment, there's no end date on the temporary deferral. So it's until we hear otherwise, that deferral is in place with no end date. So wait and see. So after all that, the most important thing for organisations to do is make sure you're aware of what leases you actually have in place. If I can give you one takeaway from today, it's go back and identify what are the leases you've got, what's the start date, what's the end date, what's your monthly payments, what's the asset that you've got access to. At very least, when it comes time to take it to the tax accountant or to see your auditor, if you've got a list of what the leases are, you can handball it to the accountant and say, do the accounting for me.
But should the leases all be similar? Because we probably about 300-400 of them at least.
300-400 leases.
Yeah. But they're all different.
And I had this discussion.
Which company are you from?
Local government, City of Stirling. We had this, I had this thing last Tuesday and actually mentioned it again this morning about the leases are all different and they're all varying all over the place and they're harder to follow, and it's hard to follow for people who want to have a lease as well. They're just, there has to be a better way. I don't know if this is the better way. I'm not quite sure if this is the better way. Although we don't have a choice, but this is
Correct. So there isn't a choice. The standard is what it is. It's already been passed. It's well past that exposure draft stage where people could actually say, I don't like it. Now it's at the get on and do it stage. But where there are many leases, it does give, the standard gives you that option of using a portfolio approach as long as there are similar terms and conditions in each lease. So that may not be the case for you, but it may be that out of your 400 leases, you can put them into groups where you might have 50 of them that are on one contract, another 100 that are on another contract, and you might be able to segment that list to then account for each group of them where they do have similar terms and apply a portfolio approach rather than trying to account for each one individually.
Well, we'd have probably at least 30 or 40 peppercorns. That's a lot of work for nothing.
The peppercorns,
I mean,
you don't have to worry about
it.
it.
Doesn't worry about skill in the future.
At some point, won't it?
But where City of Stirling is the lessor, you don't have to worry too much because it doesn't change. It's the lessee accounting that is where there's the most significant change. Definitely good to, as soon as you can, start discussing with your accountants and auditors how you're going to implement the new standard and look at your approach to calculating it. One of the things that, if you are a 30 June year end, although you only need to implement it from 1 July 19, in your accounts ending June 2019, you should be having paragraphs in there that say standards issued, not yet effective, and you're actually meant to say what is the impact it's going to have. Now, so far I'd say 90% of the financials I've seen say, we will apply this standard from 1 July 2019. We have not yet assessed the impact it's going to have. Now, if I've got a set of accounts for the year ending June 19 that have been signed off in October 19, and it says, we're applying the standard at July 19, and we don't yet know what impact it's going to have, I'd be reading that saying, do these guys know what they're doing? How can you have already applied this but you don't know the impact it's going to have yet? So for most organisations with June 2019 accounts, I've been saying to them when I'm seeing their draft accounts, I'm not going to be signing off on a set of financials that say we haven't assessed the impact yet. I'm expecting the financials to at least have a sentence or two saying, we've assessed this and it won't impact us, there's no material impact, or we've assessed this new standard and it will create an increase in assets in the region of X dollars to Y dollars, or there needs to be some comment in the accounts of what the impact the new standards will be.
Terrible, can we just write terrible?
Yeah.
Lots of words, terrible, is that what I do?
The other part of it is that in the standard there's a couple of accounting policy choices. So whether you're doing retrospective or prospective application, because those accounting policy choices need to be made by the board, it'd be good to start thinking about those so it gives you the opportunity to put it forward to the board or the management committee so they can actually minute their decisions of how are they going to implement the standard. Because as the auditor coming along, I can't make accounting policy decisions on behalf of my clients. I'm the auditor, I'm just checking the numbers, I'm not doing the accounting for you. So if I have clients that say, well, we don't know about lease accounting, we've done nothing, can you just do it for us? I'm going to be saying, well, can we get the starting point right? Are you doing prospective or retrospective application? That's not a decision I can make. The management committee or the board needs to have made that decision before I can then look at how the accounts have been done and say, yes, they were done correctly or incorrectly.
Someone would have to write a report to the board to say whether it's
more economical, whether it makes more sense, whether it's more time by the staff to go either way. So somebody has to write that report, and if the staff, the accounting side write it, the business unit writes it, then the auditor will have to make a comment before the board could make a comment.
And if
You would
the-
expect the auditor to make a comment.
If
which
the
way it
accounting
goes.
staff have written a paper or some short summary for the board, and they want to provide that to the auditor before it goes to the board, for the auditor to check, yes, it's correct, as the auditor, we're able to do that. I can look at the paper and say, yes, you've correctly understood the standard, or you haven't. And then it can go to the board for them to make a choice. But if the accounting staff have done nothing and the board's done nothing, and then it comes to the audit, and I say, well, you've accounted for this applying the old standard, you haven't even considered the new standard. That's the point, whereas the auditor, I can't come in and say, well, here's a couple of journals, just post these and everything will be sweet.
And can we do something like that? We can just go back to our suppliers and contractors just to say them, okay, can you please invoice us for the week back? Means same as for the printing, they invoice us for July, for June. Can I go and say them
in
that?
some cases, talking to the suppliers will be helpful, because it may be the case that you have contracts that either are or are not a lease, and it'll be a lot easier one way or the other. And if you've got good relationships with some of the suppliers, it may actually mean a change in the legal contract to give you the accounting outcome that you're looking for.
Yeah.
So nothing wrong with doing that, but you need to be aware of the standard first to know what the impact's going to be, so that you can then know what changes you want in the contract to get the outcome you're looking for.
Which is going to cost you money, because you have to have lawyers and anybody to do the contract. Either way, this is going to be expensive.
Yeah.
You said that like that. I don't even think, I can't recall it even being in the budget.
It was in the budget, it was a separate.
Well, because it's not a tax matter, so it's not something that would be in the government budget. So, because it's an accounting standard.
No, I mean, on our budget.
Oh, in your budget,
I
you
don't recall
haven't made
being
an
on
allowance
our,
for it.
You know, I mean, we just did a budget of 300 million, and I don't recall being allocated to this. There's a lot of things you miss, so I'm not giving that amount, but I think I would have noticed it.
I've seen some of the mid-tier accounting firms marketing or advertising services to assist with the implementation of the new standard, and the starting price is already in the tens of thousands of dollars.
See, this is where you come in, and then you should have done a little quick way of doing it.
Just send us a spreadsheet, Alastair.
That would be good.
As much as I would like to, we'll see what we can do. But there's always difficulties there, because once the accountant prepares the spreadsheet and gives it to you, sorry, when the auditor prepares the spreadsheet and gives it to the client, if there's errors in the spreadsheet, then it creates a self-review threat for the auditor, where I'm then reviewing my own work.
Yeah.
And the accounting standards say that I'm meant to try and avoid doing that.
Amanda, do you have experts?
We will.
You might be it. You might be the go-to person.
So if you're looking for more information about this, you can always go and read the standard. It's only...
How long are they?
So the standard itself is only about 80 pages long. And then there's the illustrative examples, that's another 80 pages, and then there's a bit of guidance and some other
That's another 80
documents.
pages.
So there is information there on the Accounting Standards Board website. It's really good if you're struggling getting to sleep. Or instead you can come to things like today and get the short version that's hopefully a little bit more enjoyable than reading the standard. Sign up for our newsletter, because I do actually try and write some interesting content and keep it up to date. Make sure you're talking to your accountants and advisors. And you've had since 2016 to be aware of this, but at least start now rather than waiting to 12 months' time before you start thinking about how you're going to apply the standard. So, any questions?
Any more questions?
Any more questions?
I have one question, and which is related to, suppose we have a contract with the government and they are giving us around 12 million per year, and we have KPIs for 12,000, suppose 1,000 per 1 million per month, and if we have not met 1,000 KPIs and we already have expenses for that month for 1.5 million, and how will that impact? How do we?
It sounds like that's going to be not related to the leasing standard.
Yes, but
because
yeah, not this standard, but previous standard, I think.
oh, in terms of the income standard.
Yeah.
So the issue you're saying there is that when you've got your government funding,
Yeah.
you haven't met the KPIs,
Yeah.
so you're not entitled to the funding.
No, but so they have already given us some money for next maybe 3 months.
Right.
So how much money can we use from that?
Well, the amount of money you can use doesn't change because it's whatever's in the contract.
Yeah.
The amount you recognise as income is related to the extent to which you've delivered on your performance obligations. And so that depends, coming back to the contract, to say, well, does it have specific performance obligations? And you end up
But then we will go into loss for that particular month, or that particular 2 months, or that particular quarter.
You could end up with a situation where you have more expenditure than income.
Yeah.
Because if the income is reliant on you delivering
Yeah.
performance
Yeah.
objectives, if you haven't delivered those,
Yeah.
you're not yet entitled to the income.
Yeah.
So you could have a postponement in the income.
So what does that mean if we are in minus? Do we have to?
Just means you made a loss for the month.
Okay. Means it's not something we have to give the money back to the government according to the new standards that we are not entitled to.
The money back.
No, I'm just asking.
I mean,
I'm just asking.
Giving money back is what's in the contract, not
Okay.
what's in the accounting standard.
Okay.
So the accounting standard is just which month do you show as
Okay.
income.
Okay,
If you
just
haven't shown
accounting
it as
standard.
income, it's on your balance sheet.
Okay.
But the fact it's on your balance sheet as unearned revenue doesn't necessarily mean you have to give the money
Okay.
back.
Yes. Okay. Okay. So means we still have the right to that money.
It's whatever's written in the
Yeah.
contract.
Okay.
So we have a lease where the phones the equipment has been provided, and it includes the phone calls and internet. So does that fall under this?
Phones are likely to end up being low value assets, so you don't have to worry about it.
All right.
So that's the situation where on a lot of phone plans, you pay your $80 a month and you get a handset as well as a SIM card.
I've
Of
not
course.
thought about that.
Now, it is a good example of something that could come under the standard because you have one contract, it gives you access to the use of an asset, and it gives you a service as well. So you've got the use of the phone calls, the SIM card, and you've got the physical handset that you're making one payment. The standard would then say that you would identify that situation, you would separate out of the payment you're making, which component is a payment for the handset, which component is a payment for the use of the phone calls. The use of the phone calls will be a phone expense or phone call expense as you pay it. The use of the handset you could account for as a lease following the standard, but you would then look at it and say, well, a phone is still a low value item. We're going to treat it as an expense as we pay it. So you end up with no change to what you're currently doing.
If the company have 10 phones, then which technically makes the value for more than 5,000.
Again, with multiple
Yeah.
phones, you
Yeah.
have the option to group them or not group them. One of the schools I was talking to had hundreds of phones for all of their staff and multiple remote locations. So, yeah, someone like the council with thousands of
We've got 1,200 staff, I hate to think how many phones.
so with phones, you might look at it and say, well, is it material to the accounts to treat them as an asset? And you could start having quite large numbers, because if you had 1,200 phones and they're each $1,000 each, and you were to bring them onto your balance sheet as a right to use asset and as a liability, that could have quite a significant change to your balance sheet versus treating them as an expense. And so that accounting policy choice where you're saying, well, are we going to treat these as a expense, as a low value item, or are we going to treat it as an asset, is a choice you have to make.
Well, the choice is no.
Well, I mean,
Yeah, there is no choice.
you know which choice you want and which is going to give the good outcome, but you still need to have actually made the choice in the sense that there should be a board meeting minute to say that the board has made the accounting policy choice rather than just ignoring it.
Yeah.
But you know which one you want to recommend for the board, which choice you want to recommend them to take.
So say with the photocopier, which it's a 5-year lease, I think we've been operating, it's been going for 3 years already, so the 2 years that are left, most likely you've got under 5,000. So we could make the choice to call that.
It's still not going to come as a low value asset, because the decision of low value is based on that asset when it was new.
When it was new.
So a photocopier, in most cases a new photocopier, would not be a low value asset. So even where you've had the lease for 5 years, you've got 2 years left to go, you can't say it's a low value asset.
Right.
If you're lucky, you might only have 12 months to go when you implement the standard, and you can use that expedient. But if it's 2 years to go when you implement the standard, then what you would do is look at the lease payments you've got left for that last 2 years, and that's the amount that you'll bring as your right to use asset and your liability as your starting point.
Okay.
Assuming you use the practical expedient and don't do retrospective.
Yeah.
That's
right.
Okay.
So, to take away, lease accounting, it's very different to before. Hopefully you picked that up in what I've said.
Yeah, we're not smart.
At very, very least, please make a schedule of your leases, because that's the starting point to then be able to do the accounting for it. So, unless anyone's got any final questions, that's it. And please join us for some drinks and some food.